Good morning, Alan. How are you?
Good, Ryan. How are you doing today?
I'm very good, and I am super excited. You and I just got done chatting, and I had saw you speak. It was like 2017 or 2018 at a Vistage. I think there was like 800 people in the crowd or something like that, and I was just like jaw dropped and just watching you so intensely for the whole time because I just love the topic of economics and over the last couple of years getting into monetary policy, just stuff that way down into the depths of it. What for no particular reason other than that I enjoy it. And you guys have just such a awesome way of gathering data to make it presentable and easy to digest for entrepreneurs who are not from the world of economics or the spreadsheet junkies that come from investment banking or private equity. So I just really enjoyed it. Had Alex on the show a couple times, and here we are. And you've got a lot of forecasting, and some things have definitely gone down since I spoke with Alex.
And that was yes, it's certainly been an interesting 15 months. And I remember that thing in Minneapolis because I had talked about the coming Great Depression, the 2030 thing, as I'm sure you know. And at the end, somebody asked a question. I actually went up to that gentleman afterward and gave him the answer he was looking for. But he gave me the best ending ever. He said, "So what do I have to do to miss this Great Depression?" I don't know if you remember my answer to him or not. It was you could die.
There's an easy way out, man.
Then I went and gave him a serious answer, but it sort of brought up the whole thing, though. I mean, it's coming, and you cannot not be part of it. It's a question of whether you're going to prosper in it and be prepared for it, but you cannot opt out and say, I'll just ignore the whole thing. It's just not possible.
Well, and I want to dive into this as well as, give my layperson's questions from someone that is passionate about economics. But like, before we do that, Alan, if you could give the listeners, because we had Alex on the show before, but you and your twin brothers started the business and you've got so much history in this. So maybe just give a quick overview of your background and how you guys started the business and why you guys are approaching economics the way that you are and how you work with business, because it's very different than I've seen, and then versus just theory and people that are writing columns in the op-ed.
Yeah, it is different. And thank you. First off, Brian and I did not start the business.
Oh, okay.
It was started in 1948. And so
wow.
We're old, but we're not that old. By a guy named Chapin Hoskins. Chapin was a very fascinating man. He developed some cyclical theories that we're still using today. They are foundational to our work. When he passed away, his successor was his assistant, Helen Langwasser. Helen sold the business in the 80s to Brian. In the 80s, Brian brought me in to be his partner. And Brian came from a government background. Most of his career up to that point was in government, and mine was in business. I had an interest in several businesses with a strong business background. So together, we took ITR with that mindset. This has got to be about business, to your point. And our whole thing from the beginning is make it understandable and make it applicable. Because if you don't do either one, you're just a talking head spouting some numbers and trends. And
there's a lot of those out there.
Yeah, and you have no point really. And the other thing that differentiates us is that we hold ourselves to our accuracy. You saw that in Minneapolis. Every time we speak, we say, this is what we said last year, and this is how it worked out by the end of the year. And that list never changes. And holding yourself accountable to your forecast is unique in our industry. And it gives people the confidence to act.
Why is that unique, Alan?
Because most people don't have the accuracy that, I don't know of anybody that has the accuracy that we do. Every once in a while, they'll have one that's accurate in a series.
In a point in time. Like, look at, we were right on that one thing.
Yeah, but our methodology proves itself year after year. In 2020, in March of that year, everything was falling apart. You remember, Ryan? It was just everything was in free fall, shut down. World's coming to an end. We had to tell our clients what the year was going to look like, so we did. And for U.S. GDP, China GDP, employment, housing, retail sales, we had to forecast all that. And they came in, most of them above a 95% accuracy in a forecast done in the middle of free fall in an unprecedented situation. I mean, the methodology we're extremely pleased with.
It works.
It works, yeah. And our team, it's not just Brian and I. We have a team of, I think at the moment, a little over 20 economists. some excellent brains back there that just do wonderful things.
So I want to, because I can kind of like lay out some of the topics that you and I can dive into. Because I mean, we could probably spend the next 4 days diving into any of this stuff. And again, you got the 24/7 news that does that. So we're not going to. But
Right.
you know, for you guys have this 2030 depression. I want to talk about that, kind of reset the foundation of like why that is, some of the theory behind that. And then you guys have this, I want to dive into like a little bit more about your model, but what these leading indicators are and how you guys use that. And then we can talk about, you know, all the other things that are happening kind of in the near term, like inflation and supply chain issues and, you know, the prices of valuations and assets through the roof. So lots of stuff we can park over there for a second, but like, why don't you just explain your theory on the 2030 and like your philosophy and, or not the philosophy, but the model, how you are predicting that and why.
Yeah, okay, happy to. It begins with the cyclical theories, which are unique to ITR that Chapin developed. We don't ever lay out those theories in detail. That's our, Coke formula. That's a secret sauce. But they pointed to it a long time ago. And so Brian and I wrote a book in 2014. It was published in 14. We started before that, called Prosperity in the Age of Decline. And through there, we dove into, okay, we see no inflation now. We see, pleasant interest rates, but we see governments across the world really beginning to take on debt like it doesn't mean anything. And we looked at the demographic trends around the world, the boomers around the world aging, and the cost that we bring to an economy that in other countries not being replaced by younger folks. China's population is in decline. Japan's population in decline. Russia, not a big country anymore, but their population is in decline. In the United States, we're still eking out some growth, but we're so expensive in the United States that we boomers are a major cause of the Great Depression. It's not a pleasant thought, but what you have to do, Ryan, is form, pillow squads and come take care of me in the night. And
Pillow squads. Well, what would you like to smell on your last breath, right?
Lavender, of course.
Your lavender. There you go.
But that's an unstoppable train. And the question comes up, did COVID change that? And COVID was dramatic and tragic, and I in no way want to minimize the deaths that occurred, but not nearly enough to change the trajectory. And there are 40 million in this country right now drawing down on Social Security and prescription drugs and Medicare. That's going to almost double next decade. And you, my friend, have to pay for that. And it's either going to be through increased debt, you pay interest, or you're going to be seeing more taxes. And guess which one I'm betting on?
Well, and it's so, there's so much behind that too. And while you're talking about this, Alan, I read a book by Ray Dalio called Changing World Order. I don't know how familiar you are with his work or anything, but there's also a book called Managing Big Debt Cycles. Right? And so he's got this whole philosophy from his research at Bridgewater that there's the 3 stages of money. So it's the hard money, and then it's the note backed, and then it's fiat. And then every single time the world denominated currency, everybody essentially goes bankrupt, and then they have to start all over again. Yeah. So I don't know if this like correlates with your guys's.
That's it. And so back then there was no modern monetary theory. That's a relatively new thing. You're into econ. You know MMT is out there, and while it's unofficial in this country, it's very real.
Yeah, right. Yeah, absolutely.
That's exactly what's going on, and that has a long-term implication, not just to the value of the dollar, trust in the dollar, devaluation of the dollar, creation of more inflationary pressures, which is higher interest rates. And that's always tough on a population and on businesses. I mean, there's no, hey, that's going to be benign forever. That's never been the case.
Right. I mean, like, because at some point, like, I think about, like, as you're talking about this 2030, like, I remember when I first watched you, I was like, oh, that's super interesting. And I could kind of like feel it, but like over kind of, clarify my own puzzle of knowledge, which is the more I learn, the more I know nothing.
Yeah,
it's like at some point, someone has to make a return and someone has to make money. That's the whole point of money, right? Like someone has to have goods in exchange, exchange goods and services using money that people believe are going to have a upside. And when there's no interest rates, I mean, these big pension funds and insurance companies can't make any yield. So like they're going to have to go somewhere
Yeah.
for yield.
Yeah. And they will, and they'll take on increased risks, or they will back the fastest horse. But what you just said struck me as fascinating, because I know who your audience is, and they're people like you and I. But do you realize how many people out there think what you just said is wrong?
Oh, I know.
And in a culture like that, how do we not drive the bus to the cliff? Because in that culture, it's like, well, just print it and spread it out. That's all we need to do. It'll pay for itself. How can it not pay for itself? And so
It's crazy, Alan. Like, so I got done also, and I'm always like a kid in a candy shop with you. So like, because I don't like, it's like me in my dungeon, just like talking to myself, right? I just got done reading Changing Fortunes by Paul Volcker. I don't know if you ever come across that book. And he talks about this stuff, and it's such a simple book and how he writes. Like every business owner could listen to it. And then you go all the jargon today with derivatives and all the manipulation. It's like, well, it's all fake money. And he goes back, he's talking about Bretton Woods of like back in the hard dollar. Like this is how it works. Yeah. And you just can't do this because at some point it doesn't work. Yeah. And it's just interesting that like that's debatable.
Yeah, you're right. The redistribution of wealth. And I'm reading a book, and I quote the author if I could. I just started it. It has to do with, and it was written in 2009, back in those dark days. But it really had nothing to do with the Great Recession. But how, and this will get me in trouble on most radio shows. You're fine because you're audience, but
there's not a bunch of academics that are going to challenge different different angles or
right. But the point of the book is how the redistribution of wealth through the welfare state hurts economic growth and hurts what people make, and has a negative impact. It's an academically written book, so it's not for everyone, but it is compelling. But his basis real early on is key. He says they don't want equal opportunity, they want equal. And in no time in history has everything been equal. There is no point in history where that has worked. And when people have tried, it's failed miserably. And yet that's exactly what we see now, where whoever you are, it has to be, and the other word is fair. Everything has to be fair. Now, what the heck is fair? I have 6 children. One of the first things I said to each of them, I held them up in the air. I go, remember, life is not fair. Whatever you do, remember, life is not fair. Just isn't.
I have twins too, Alan. I have twins too. They're 4.5, and yeah, they're wildly different. Well, it's interesting
because the culture works against. Back to the premise. The culture is working against sound financial thinking, which makes it easier to see the bus going towards that 2030.
Well, and let's pull that thread, because I think that's going to give us an awesome foundation for the conversation, because sound financial thinking is that someone has to make a positive cash flow and increase their balance sheets. And it's so interesting, Alan, as all the different debates about different policies going on, I think about like any one of our companies, in even my old business when we had the turnaround experience. How can you argue about one line item on the income statement if you don't know how much money you're supposed to make? Like how like I would just think about, in my old business, we had, it was a copier sales. We had a copier business. So we had 20 very hungry salespeople who loved to figure out how to juke the comp plan to make more money. And the thing is like, they always want to make more money, but if the business isn't doing well, no one's going to have a job.
Right.
So like, if we're all doing well, then we'll introduce profit sharing. We'll do more benefits. We'll go on President's Club. We'll do a lot of things when we're growing and we're creating cash flow. And when we're going down, we don't. Like everything has to be looked at in total of a cash flow statement and a balance sheet. And without it, then it is just kind of this like arguing over nebulous topics without any kind of footing in anything.
Yeah, absolutely right. And seeking after financial equality and seeking after fair is a task with no end, and we'll never get there. We'll never be satisfied. But in the meantime, we'll make sure that we punish the rich. Remember, it's an old song from 10 years after, but the gist of it is, tax the rich to feed the poor until there are no rich no more. And one of my favorite groups is the Temptations, Ball of Confusion. And in there, there's a lick that says, and politician, this was written in the late 60s, maybe early 70s. Politicians say more money will solve everything. I mean, nothing has changed over the years.
Isn't that
It,
crazy?
it is crazy. So that's why we're going to go there. Higher interest rates, inflation, people in debt, governments in debt, businesses in debt. And we've been lulled into thinking it's all okay. It'll all work out somehow. And it won't.
So how do we how do we as a society and business owners and people trying to navigate this? And I know we'll get to like what are the things we can do about that to prosper in it, like you guys wrote the book on. What are you seeing now? Like, so maybe take us back to when the pandemic happened and you're having to readjust. And I actually saw Alex speak in October. And I was like, and then I think he was on the podcast last April. So we kind of had a little bit of, okay, we're in free fall and you guys were kind of probably formulating where everything was going. But what did you predict? And then how does the short, and I don't know where you want to go, whether it's the short term and how that ties to this 2030 forecast, like what's going on with supply chains and inflation and just kind of
Yeah.
your overall
It
input on
sets
it?
it up. I mean, your segue is right on target, Ryan, because it sets up the future today. And we're seeing some inflationary pressures that are real, the PPI and the April push in the CPI. And there's this justifiable concern in business that, oh my gosh, this is upon us. And there's a generation that has never seen it. And so
Mm-hmm.
they're dealing with another new phenomena right after they got through COVID,
Mm-hmm.
and they're getting hit in the face again. Us older folks, we go, oh, okay, that again.
Mm-hmm.
It gives you an
Mm-hmm.
entirely different perspective. The bottom line is we're getting a taste of inflation. It'll be interesting to see what we learn as businesses from it. Now, your listeners should learn that they should know this is temporary. We're not going to see massive systemic inflation for years. Think at least 3 years, 4 years, it'll begin, and then it always cooks up. You know, your
Mm-hmm.
stuff. But have them ask themselves, all right, what are my major takeaways from this? When I start seeing painful inflationary pressures, what should I have done to prepare myself?
Mm.
Um, how could I have known? There are ways to know. There are leading indicators. There are things to tell you. There's ways to manage your inventory, your pricing. Which PPI are you going to use for an index to have in your contracts? I mean, there are specific things that can be done, but learning is the big thing. And then for your listeners, do not think this is going to be the same in 22. The rate of rise in these commodity pressures is about over. We're going to see plateauing, like in copper and aluminum and that sort of thing
Mm-hmm.
for several quarters. So they need to adjust to that reality real quickly, and hopefully they will. That's, to me, is a big takeaway. And then we'll see some normalization, and then it'll go up again. Second half of this decade, we enter into the Roaring 20s. It's a new concept for a lot of people. Now, as far as supply chain goes, that one was that for us was like, what the heck is going on?
It's crazy. I mean, like, so it's so interesting too, and because to going back to your inflation, what could you done about it? This is a couple of real life client stories here. Is we had a manufacturer down in Florida, and all of a sudden, their cargo from overseas, it's like whoa, for
Yeah,
280% up, and like millions of dollars disappear
yeah,
in working capital or whatever it might be. Another home remodeler, all of a sudden you got the inputs that are doubling in price while they're quoting jobs.
yeah,
It's like,
yeah.
so you're trying to push that through. And I'm watching that golf ball go through the system because they're trying to pass it on as fast as they can to their customers so
Sure.
they can maintain what's going on. And it's like, how do you prepare for that, but then also adjust it accordingly when it tapers off too?
Well, one of the things that we learned in the old days was that, and we stopped doing this because inflation was quiet, was that in your contracts you had a price adjustment triggered to, some people use the CPI. That's wrong. It should be triggered to the PPI, a relevant producer price index. And it was just in the contract. And when there was no inflationary pressure, there was nothing there. But there was a built-in trigger that would protect you if all of a sudden something happened. And
Interesting.
and I mean, I had to have a roof put on one of the properties my wife and I own, and the price doubled. And from something I'd gotten a price on a few months ago, and he was apologetic. I didn't try to hold the guy to it. I'm not trying to put him out of business. But plywood, to your home builder thing, plywood has just gone nuts. So you can protect yourself. He could have had that clause in there and just said, "Well, hold on, the PPI is done. Here's your new price."
So interesting. Yeah. And go back to like what, so you got the fact that we just hit the throttle on the money. So you watch these assets go up, but then also that's inflation. Well, that's one component of inflation, but then you have a lack of supply of
Yeah.
inventory too. So you have both of those that smash together at the same time.
Right. And they both self-correct is the beautiful part of it. And the money supply is a fascinating subject on its own. You and I have just lived through history that I hope we never see again, both in terms of the pandemic and the sheer amount of money that was put out there. And I'm not against helping people. There are different mechanisms, and don't take that as an anti-people statement. Just
Hmm.
there's always the law of unintended consequences. You're well
Yeah.
aware of that, and so are your listeners. And what has happened here is all that money is produced, besides the pent up demand and the stay at home, has produced the ability to demand goods. And that has created a surge in demand that will drive up prices and cause shortages in and of itself.
Hmm.
And that goes away unless we see that President Biden and company are going to continue another 2 trillion round, another 2 trillion round. Those checks are stopping. And in September, the federal unemployment insurance stops. And in September, all the kids go back to school. So as those things happen, we expect we're going to see this thing that we used to call normal appear. And consumption returns to normal levels. Life returns to, I got to commute, I got to take care of the kids. Now, there's some great tax benefits now for parents that have to put their kids in childcare, and that's another subject. But that demand side of the curve slows down. Same thing with businesses. Businesses were slammed, right? And as businesses were slammed, they could raise prices. They had to raise prices. Their input costs were up, and they could get more. But when demand slows down on in the capex sector and on copiers or whatever happens to be, your prices have to adjust that.
Hmm.
Without the stimulus coming into them, without the consumer demand, without the urgency, we're going to see things stabilize on the demand side, and that leaves the supply chain a chance to catch up.
What'd be interesting to see, Alan, is if and I'm curious on your guys' forecasting, like, is the demand going to go back for goods and services the way it was? There was a bunch of articles over the last 15 months about, the all the money, the bridge to nowhere. Because I'm very familiar with what a bridge loan is to get you by the next payroll. Like, this is like, I will look inside of the balance sheets of a lot of our clients or or anybody that I've talked to, and they have more money than they've ever had. I literally, like, Alan, I'm not even joking. I was talking to a friend of mine who owns well, they call it opportunity financing, but it's essentially, just I mean, they give people loans not backed by any collateral, high interest. They have thousands of customers. They usually have issues with, like, I think it's 25% of people, bounce and then they clear. So it's only like 5% bad debt, but they had zero people
Wow.
with issues, not one in the
Wow.
last like 6 months. It just shows you that there's that much money in there. So
Yeah.
it is like, and as we look at our forecast of our clients, is that money going to get them to the point where their demand and their new cost structure is sufficient to maintain their business?
Yeah, the demand will be there and it will be sufficient. They'll have the cash to get them there. There's no doubt about that. And I think, let me see if I can rephrase it. If I'm looking at non-defense capital goods new orders, which is a great measure of capex, it's already at record high levels, but it's ascending at a extremely fast pace, an unsustainable pace.
Okay.
When the rate of rise slows, we're still at record high levels. So your customers are still feeling record high demand, but not at a 25% year over year clip. It's down to a 7% year over year clip.
Mm.
And so they'll need their cash. They will need the efficiencies. They will be happy. They will be happy with PLs and balance sheets and all the rest of that. They'll actually be happier because when it goes to 7%, all of a sudden supply chain can catch up to that. And those
Oh,
woes begin to go away. Because container shipments into this country are higher than they've been for years. We keep hearing we can't get containers in. It's a series that we look at the containers from the 5 busiest ports in the United States. They're up well above where they were before COVID.
oh,
It's,
wow.
it's just because of the demand pull.
Oh, yeah, interesting. So I think this is a good spot explain your leading indicators and how those work. And I don't know if that ties into like how you're forecasting. You could kind of explain your model and how you forecast with the accuracy that you guys do.
Yeah, leading indicators are an important part of it, and we also use rate of change. So I'll touch on both of those things
Yeah, awesome.
if you don't mind. I'm going to start with rate of change, actually. Rate of change is what our first book was all about. My brother and I wrote that, don't even remember how long ago. It's called Make Your Move, which, by the way, is a terrible name for an economics book, but it was okay when we wrote it.
It didn't age as well as you wanted it to.
Well, you Google that name, you don't get our book. Let's just put it that way,
I can only imagine.
So, but if you go to Amazon, you're not going to get anything bad. So just use somebody else's computer if you want to test that one out. But it's a tool that all your listeners can use. It applies to every industry, every business, because it's a way to measure the business cycle pressure. And we're all about the business cycle. There are 4 phases to the business cycle. We talk about the psychology of each, the strategies as you go into them, the tactics while you're in them. They're standard sine wave, okay? 4 phases, 4 quadrants. But how you know you're getting to them begins with knowing your rate of change, because there are checking points and it's a methodology. It's not complicated. This is the sweet part of that. And if somebody wants to go to my website, we have a video on it. It's free. We have written literature on it. It's free. So
We'll put all those links in the show notes too for everybody.
Okay, thanks. It's there. So it begins with the rate of change. And so when you know where your rate of change is going, all right, I'm climbing this hill. How long am I going to climb the hill, and what will that rate of rise look like? Are the 2 questions you have to answer, right? Your rate of change will tell you, all right, I'm going to keep climbing for the next 3 to 6 months. I want to see further than that. That's where the leading indicators come in. That's why I want to start with the rate of change. Your short-term view is driven by rate of change. We use a number of proprietary leading indicators, but we also use others that are out there. The Purchasing Managers Index, we just make it into a rate of change because it sees better and smoother. We can look at what's happening in bonds. We can look at what's happening in JP Morgan Global Manufacturing Index. I mean, there's no lack of indicators, and we have our favorite 15. And we see which ones relate best to the company or to housing or to whatever the industry is. And those generally will give you 6 to 18 months into the future, the best are 18 months. So say 6 to 12 to be comfortable. So my own numbers give me my next 3 to 6. Lead indicators give me the 6 months after that. Now I have a year's view into the future. Now I can plan.
Interesting. So going back to the rate of change, maybe I want to just do another brush up on that. So I think because of everybody watching the COVID rates over the last 15 months, I think more people are more familiar with rates of change now than they ever thought they would have because of how they were looking at data. But can you just kind of give your overall explanation of it again?
Sure, I'd be happy to. What you do is you take your last 3 months worth of data. So let's say it's March, April, May, and you compare March, April, May of 2021 to March, April, May 2020. Now it's going to be fluked because of COVID, but just work with me on the example. Then I'm going to take the next 3 months, so it'll be April, May, June. Then I'm going to take May, June, July, and in those 3 month groups, I'm going to compare to a year ago. And if the number that's derived there, which is the rate of growth, is going up, then I know that even if the number that I'm looking at for July is down from June, as long as that rate of change is going up, I'm saying, well, I'm still ahead of last year and there's positive business cycle momentum. So I don't look at a down month and go, oh, I look at it and I go, normal, and don't shrug it off because your rates of change say you're going to continue to grow. And that really does drive you away from the minutia and say, well, that may have been seasonal, it may have been a short month, it may have been, but I'm still ahead of where history says I would be. So I'm good.
That's fantastic.
And then you do it for 12 months at a time to finish your question, because then you get the broader brush and you can bet the farm on that 12 over 12 rate of change, because that will let you know I'm in phase B, I'm going up, man. And I'm going to be going up for X period of time, especially when you use leading indicators.
Super interesting. And there's some good correlations between that and the trailing 12 months of the income statements and the graphs that we're very familiar with. You can show people, hey, like this, instead of looking at the calendar year over year, you're like, well, year to date, what does that tell you? It's like in the vacuum, it doesn't do anything.
I know. Isn't that so true? I still run into that and I go, I wanted to ask that, but I don't. I bite my tongue, but I go, okay.
Okay, what does that mean? Like, yeah, right. Thank you. You've done this. Yeah. It just allows you to see. It's not a crystal ball, but you can better clearly see what's hopefully in front of you, because you can, again, like you're saying, you can see that this is normal, but the change is going this direction. So you can a little bit anticipate what's going to happen. So how do you take that 3 month and the 12 months and then extrapolate these leading indicators into a 2030 forecast?
That's too far out. To your point you made just before this, and I will get back to it, I promise. What we have found out is that 8 out of 10 of our clients say that we have increased the confidence in their planning
Oh, that's awesome.
because of the tools that we just talked about. Yeah, it is awesome. That's one of our goals here, is to help businesses see the future first. That's our passion, is to see the
Yeah.
future first. Now, it does not help for 2030. There you got to go to logic, and you go to math. When inflation reaches this height, what does it do? When interest rates reach this height? And our cyclical theories drive that thinking. And as we get closer, it'll be the rates of change. But right now, there are no leading indicators that go that far. It's only logic, which you and I were chatting about.
Yeah.
It's just, it boggles the mind that one could think that there's no recourse, or there's no end game, there's no consequence to the things going on.
Well,
I'll
it
do
is.
drugs, it'll be fine.
Well, it is crazy. I know. And like, and it's so interesting that where is the logic, Alan? Like, I'm so confused in why you can watch super sophisticated people, and then like they're just kind of, I don't know if it's so deep in the trenches of jargon and their academia that happens, or like, because I mean, I'll sit there and my wife has gotten so sick of me over the last couple of years. Like, can you believe this? And she's like, Ryan, people know what they're doing. I'm like, I don't know, but like if you just take the common sense lens, it doesn't make any sense.
Well, I think they are super smart. You're absolutely right. Take nothing away. I think sometimes we can get so involved in our own theory that we don't look around. And the other thing is, innately, human beings are straight line forecasters, straight line thinkers. So
Mhm.
I'm looking at today and I'm going, yeah, this works. I'm looking at tomorrow, go, yeah, that'll work. And as long as this data set continues, as long as this world doesn't change, this will work. But
Mhm.
there's the falsehood, right? This world will change.
Mhm.
And what happens when you bring in those changes is the key.
Mhm.
And I think that's part of it, because you're right. These are exceptionally brilliant people, but I think they forget to factor in change.
So what are, with your book about how to prosper and what's about to come, so we're, middle of 2021 now, and we got, 8.5, 9 years as we're looking at this going, okay, well, 9.5, I should say, sorry. What services or industries, I mean, like as you think about different companies, like what are the ways to prosper and navigate through these choppy waters?
Yeah, well, big question.
Yeah, right. Tell us all exactly how to be millionaires, Alan. Come on, it's super easy.
2 minutes, go.
Yeah, exactly. Yeah, back to the sound bites, and then we'll push that all over on YouTube.
Yeah, exactly. You do have to be in industries that will be in demand even with a Great Depression upon us. Now, that's not as tough as it sounds, because let me set the stage. A Great Depression means somewhere around 25% unemployment. It means falling prices, falling stock market, but that doesn't change basic human demand and human needs.
Hmm.
So if you're in a high-end restaurant business, you're going to see a lot of empty tables, but that doesn't necessarily put you out of business. What you're more likely to see is more like the Great Recession, where restaurants back in 2008 and 9, what they saw was a lot less table service, and people were not ordering cocktails and dessert. They were choosing one or the other, and the cost of the entree went down a little bit. I mean, that's the type of thing you got to drive your thinking to. If I'm in a world that sells high-end designer goods and the stock market took a dive, your business is cooked. But if you're somebody that provides the good and the better, and not dependent upon the best in the marketing model, it's a different world. If you're selling automobiles, I'm sorry. If you're selling bicycles, good deal. You know? Education is good because people will get new training. Uh, I think the climate change and initiatives there will be steady work.
Hmm.
Healthcare will be good work. engineering services of just about any kind.
Hmm.
Good work. Economic consulting firms, we hope is good work.
Uncertainty brings good work.
Uncertainty does bring good work. But things that must-haves are certainly the trucking industry. You're not going to need as many trucks and as many truckers, but let's assume one of your clients is in the trucking industry. Let's latch onto that one.
Hmm.
All right. And I'm running, pick a number, 40 trucks, and I'm maxed out, and it's in the second half of the 2020s. I'm covering costs. I'm making money. I'm tempted to add more trucks because I'm straight line forecasting.
Hmm.
That's the fellow that's going out of business. Now, your listener, because they're in tune with you, says, you know what? I see all this happening. I see what Ryan's talking about. And what I'm going to do is keep my prices going, but I'm not going to start adding a bunch of trucks. I'm going to be willing to pass on some of that growth rather than be overextended and rather than have too many people. And you let attrition in 2029 start taking care of some of your people losses, and you're going to lose your loser clients, and you're going to stick with the industries you know will continue to need trucking. So car parts are out,
Hmm.
and that sort of stuff. And that fellow, that company, that person is going to be able to downsize their business at a profitable level and operate now with 30 trucks and still be profitable because they won't have overextended and they'll be in the right industries. So trucking is not going to go away, but the trucking company who decides that sky's the limit, bang, that's one of the keys.
Well, and let's take that example and continue it, because the linear thinking and the the behaviors that come with that, like saddling the company with debt,
Yeah,
buying additional companies. And I'm watching, Alan, like you and I could have a heyday with stories of what's happening with, I mean, private equity is eating the world. I mean, it is so ridiculous because I'm watching, and this is, you can absolutely correct me if I'm wrong, but all I can think about in my head is I see like, okay, all these pension funds that are pretty much broke, and the insurance companies that can't get any yield, the endowments, all these people are looking for yield, pushes it into private equity that normally got 21% rate of return. Now, whenever the GPs are going to give their investors back the money, who knows what the actual internal rate of return will be, but they're leveraging these companies, Alan, in all these industries because they have to deploy the money. So your example about riding the wave in a sustainable way for the trucking industry is not possible when you've essentially forecasted the debt levels with that company according to the current demand.
yeah,
I mean, it just doesn't work.
right. You're right. It takes an owner, you know, Melinda owns this trucking company, okay? Melinda is belonging to a trucking company association. She's hearing about, I'm buying this, I'm growing this, and I'm expanding, and I'm buying into this new
Hmm.
marketplace. Melinda has to be willing to sit there and go, they're going to think I'm stupid. And that's hard for a human being to do. They're going to think I've lost my nerve. As a CEO leader, she's not going to want people to think that she's lost her nerve. She's actually showing more nerve than they do, but they just don't believe her. So it's going to take a CEO with iron and extreme fortitude to forego that boom mentality, because the politicians are going to say everything's fine and hold back and not get. Are you familiar with Tugboat and Evergreen?
Tugboat. So Vicky Tennican, who wrote the Century Club, was just on the show. So she was
Oh,
talking.
okay.
Yeah, she was talking about 100-year companies.
Yeah,
It's so
yeah.
crazy.
I just got involved with those folks. That's the mindset that's needed, is the
Yeah.
evergreen, and that I got to build this built to last. Not the book,
Uh-huh.
but the mentality. And I think that's how you avoid that trap. And of course, if you sell out to private equity, you've cashed out, and you're just going to stay on for as long as they'll keep you.
The only thing I would add to that though is like when a lot of the PE firms, they're making people roll equity in, and that can be wiped away because all of a
Oh yeah.
sudden now the company's got all this debt, they don't run the company, and then this catastrophe, when and how it happens in their industry, however it comes. I mean, there's a good chunk of their wealth on the table with it they can't control.
Well, that's true. Nice part is there's a lot of bidding going on for companies now, so you can choose the one that doesn't have you roll over as much or roll over any. If
Hmm.
you're willing to, it's a greed thing. If you're willing to take a bit smaller price
Hmm.
in order to reduce your risk, that's what it comes down to, right?
So true. And so kind of shifting gears, how does the rest of the world like taking this from a global perspective, so you got the US with a world denominated currency, the Fed's printing. Our output is a lot less than it used to be back in the 60s. And so with our issues with China and inventory and all the stuff that we found out, and was it 2 days ago that China is now allowing people to have 3 children?
Yeah.
So you have all these dynamics of the central banks ballooning with their own balance sheets. I mean, how does this on a world stage impact the next 9 years?
Wow. Yeah. Some of it, it impacts, the inflation, and it can impact the risk to growth because of China. If we end up at war with China, I mean, you brought in so many subjects. My mind is pretty much
Yeah, like almost a paralysis.
the
Well,
kaleidoscope of
yeah,
stuff just went by my head, and I was trying to grab pieces of it as you were going on.
let me refrain it for you, Alan,
Okay.
because this is why I said I'm a kid in a candy shop where I just grabbed a bunch of candy out of out of a bowl, hoping to get it all at once. I think it's the position of the US on the world stage. And because we're the central players right now that are kind of, regardless of how we act, we're impacting a lot of people. And we now have a rival from technology to, the actual soundness of other currencies. I mean, there's just a lot of stuff where we're not like we used to be. And maybe I'm wrong, but I look at like where we are compared to when Paul Volcker wrote his book, and I'm going, we don't have the clout we used to, and we got to coordinate our efforts because of pressures that from China that we've never seen before.
Right. Okay. Thank you for simplifying for my
I apologize for the first
aging
one.
brain here, but a couple of things you said that I want to make sure that we're talking the same language. You mentioned before, and you just kind of bumped up again. We're not what we used to be on the political global power structure scene. Yes, because economically, we're almost at record manufacturing output in this country. We will be next year. People don't even
Wow,
think we manufacture in this country. It'll be record output. So we don't want to make that mistake.
that's super crazy. Yeah, I
Yeah.
didn't know that.
We're the second largest manufacturing nation in the world. And most people think we've somehow lost our mojo and we just
Hmm.
can't do it anymore. We're the second largest exporter of goods in the world. China is larger, but we're the second largest. And on a GDP basis, we're the largest economy on the planet, and we will be for decades to come. So I don't want people to get the idea that we're losing our way.
Hmm.
We're becoming more collegial, if I may put it that way, on the global scene rather than being the bully
Hmm.
stick that Roosevelt talked about. We're consensus builders more
Hmm.
now.
Hmm.
So I just want to set that stage.
No, that
And
was super helpful, Alan. It really was.
okay, thanks. Now let's go back to China. Fascinating subject, and I love talking about China. China's got more problems than we do. We just don't hear about them. Their pollution is rampant. They have to deal with it. We know that's expensive. Our CO2 levels in this country, Ryan, have been coming down for years. For some reason, Americans aren't told that, but it's independent sources showing our CO2, and so are Europe's. China's is still soaring.
Hmm.
Now, that puts us at odds, especially with President Biden, who is all about climate change. And that's neither plus or minus, it's just a reality. So we cannot have a bon ami relationship when they're killing the planet, in our view, and we can't allow that. And
Hmm.
we also have taken a stand against China on genocide and on dumping goods. And, our relationship with them is strained to the max.
Yeah.
And they have shown that they're willing to shove back. President Xi has, in diplomatic language and in action, pushed back on President Biden, which was like well, where'd you get the nerve to do that kind of moment? But he did. They've known each other for decades. And they distancing themselves from the United States and making nice with Russia, which is new, and building stronger relationships with Europe. If you want a lot of rare earth minerals right now, it's controlled by China, whether it's in Africa, Brazil, or in China. They got it. And so they're shoring up their power. Tensions increase. Either it's a Cold War or it's a heated up trade war that we seem to be on the path towards. We win. How do I know we win? Because we don't have the size army that they do, but we still have a Blue Sea Navy that's better than anybody else's in the world by far. We have more aircraft carriers than the rest of the world combined. I mean, so our naval power ensures our sufficiency. That's one of the reasons why I get kind of nervous when people say we don't need the Navy. I go, only if you don't want to maintain our primacy.
Well, I
So
mean, they got the China's Belt and Road. I mean, they're
they're
trying to
built.
figure out, yeah, they're trying to figure out how to build their own their
Yes,
own
yeah,
infrastructure.
they are, and it's impressive work that they're doing. And this is a bit dated information, but I remember talking with somebody in the Pentagon, and this was not a state secret, so I can say this, but this was years ago. One of the Chinese surfaced a submarine near one of our aircraft carriers. I mean, that's a big no-no, but it was certainly an in-your-face, flip you the bird moment. Uh, so what we did is on a day, we had 6 of our ballistic missile submarines surface at the same time around and then go back down. But they were caught on satellite. And it was like, don't you even think about it. We're here in the depths.
You got 6 birds.
Yeah. Yeah. So that has not gone away. I mean, the tensions have continued to increase. That's part of what your clients and your listeners have to keep in mind, is that this reshoring effort is only going to pick up speed because the instability of that global supply chain is only going to increase. You asked about that a while ago, and I kind of drifted off of it, and I just want to bring it back. Reshoring is real, and they're coming back for a long list of reasons. It's not just too much time on ships. I mean, it's the reshoring initiative. You can Google that. It's got a long list of reasons, and I've compiled them. We're going to see it continue. Your clients have to be aware of that. That's going to help them also as we get to the Great Depression scenario, or even to the next 8 years, because of the tensions we were just talking about globally.
In what ways?
They'll be able to get what they need domestically, as opposed to waiting for that container to come through. And a container that was $2,500 to ship across the Pacific is now $15,000. It'll go back down, but that shows you the pricing pressures that you're under, versus something that you were getting domestically is now, it's more expensive, but not like it would be through tariffs.
The price discrepancies aren't as much as they were before.
Correct. And the availability of goods is greater. I have clients who go, it's not really an issue for us because we getting our stuff from Canada. We're getting our stuff from Mexico or in the United States. And by the way, our trade relations combined, Canada and Mexico, is greater than that of China. So, I mean, our nearest neighbors are our best friends. So that reshoring gives them some security, some help. And the more that their customers are involved in reshoring, it means that, again, the trade relations aren't going to sour. As much as we may not understand Arkansas, we're not going to go to war with Arkansas. We're just
yeah, you don't have a bunch of state wars going on.
Yeah.
So that is super interesting. Is the because of the reshoring, is that also going to help the businesses over the next 8 years as they, in something that might not be as viable in a quote unquote Great Depression, might actually be viable because it went from very little manufacturing in the US to actually even having a demands? Like that,
Yes.
is that going to mitigate any of the impacts of this 2030 Great Depression you're talking about?
For those that are in the game, yes, absolutely. Those that are manufacturing, distributing, developing services that are in the related fields, it certainly helps a lot. And as far as the overall impact of reshoring, mitigating the depth of the depression, perhaps I have not really tried to run any kind of numbers on that, but you could certainly argue that in some localities where there's this factory employing 100 people, and that's a needed factory, it's not going to go away. You certainly made things better there in a Great Depression than you would. It's a question of whether nationally it produces something.
Yeah, like on the bigger picture, if it's making a dent. So I know we're getting short on time here, and it's just as you can have a small comment, and I'm not going to do the kid in the candy shop thing to you again, I promise. But one of the things that Alex and I talked about a couple of years ago when we first started talking is this whole baby boomer wave of business owners that are going to have to pass on. One of the things that I continue to see, Alan, is that you got, the 5% of companies that are over the $100 million mark, and you got everybody else that's smaller. They don't have a bunch of value in their businesses as much. And so I can't remember what the stats were, Alan. It was like out of 6 million privately held companies, there's like 5.6 that are below 5 million in revenue, and then 300 and some thousand that are between 5 million and 100 million, and then whatever percentage above that. There's not really a lot of wealth there. There's a lot of jobs that need to be transferred to people that are my age that can go in and run a business. I mean, is this in your data sets at all, or any comments as far as like that overall trend as it goes towards that 2030?
Yes. To answer your question, the short answer is yes. I have a comment.
Whether it's another podcast is a different story.
I think the transfer of wealth that people talk about is overstated
Mm-hmm.
because it is in pockets, is not ubiquitous for the reasons that you stated. Now, wealth is also very much self-defined. If I have a business that is $1 million business, it's not classified as anything other than a small business. I employ 20 people, $1 million, but I'm making 100,000 a year. I'm doing better than median. That's a good income.
Mm-hmm.
And I sell it and pocket $500,000, multiple of 5 off the EBITDA. All of a sudden, geez, I'm feeling pretty good, and I feel like I'm wealthy, and I'm able to pass on some money to my kids. So it doesn't rise to wealth the way we think of it today, but at the individual and family level, that's significant because
Mm-hmm.
that just sets somebody up for a different future than they had before. Or even better, in my opinion, because of Evergreen, I have an offspring who, of some kind, niece, nephew, whatever, that wants to run the business. I do an internal sale to them, and I've continued the legacy. I've continued 20 jobs, and I've just, in my opinion, made the world a better place. It's a transfer of wealth of a different kind, which does involve my monetary benefit and a future legacy that I think means something.
That's a very good point. Yeah, it's a very good point. You're passing on that income and that potential for wealth creation within that business. That's really awesome.
Yeah.
So I know we're rounding out, and this has been a lot of fun, and I apologize if I was shooting you with too many darts at once. But as we think about the very, very near term, the midterm, and then the 2030, any words of advice for someone on a high level of like how to manage those three different kind of timelines and as it relates to their company?
Yeah, take risks now, as in invest in your business for future growth. You have to do that. Just make sure you understand the level of growth. That's number one. Number two, do not straight line forecast. And because of that, number three, make sure personally and corporately you have as little debt as is humanly possible by the end of this decade. You have a mortgage on your home, fine. Don't go get that Porsche with a big car payment. Don't have your child, well, yours are too young, but don't you think in 5 years to go out and get that mansion that will stretch your income level. That's the worst thing that you can do at business level, personal level. Do not stretch at the end of this decade. You go comfortable and conservative. And then fourth, you want to be ready to get out of the stock market fast, and we can help you with that. It's the leading indicator thing again. We had that discussion, and go into bonds at the right time. You don't want to time the market, but before everything goes down, you want to make sure you're into bonds, not U.S. bonds. Different discussion, different webinar, different podcast. And then partway through that Great Depression, you, Ryan, are going to take the money that you have parked off to the side. I'm going to make up an amount. Let's make $2 million. You just have discretionary. So around 2036, you're going to say, you know what? Everybody thinks this will be stupid, but I'm going to take my $2 million. I'm going to put it into equities. I'm going to put it into the ITR optimizer. I'm going to put it into an index fund, whatever. That history says that $2 million in a relative short time is going to become $4 to $5 million. And now, because you were conservative here, you've reaped really large outsized benefits here just a few short years later because of this Great Depression. And you can buy businesses, you can buy real estate, you can buy small islands off the coast of Maine, you can do all kinds of things in a Great Depression.
Well, I just even think too, Alan, I'm tracking what you're saying is like, even your generation with the baby boomers, people are going to have to transfer their assets at some point.
Yep.
So not only is there the economic issues, but then there's the demographic issues that kind of go right inside with it.
Oh yeah, absolutely. Although I have told my kids, my plan for them is that I will have spent every last dime. So I didn't want
plan to work hard.
No working about. Go out there and work hard.
I love it. Well, we're already a little bit over. So 2 final questions. The first one is I ask everybody what the word intentional means because it's the name of the show. And I love to hear everybody else's response because they're so different. But what does the word intentional mean for you?
Uh, First thing that popped in my head was doing it on purpose.
Wow. Drop the mic. I love it. Second question is best place to get in touch with you, ITR, and all the materials that you guys have.
Thanks. ITReconomics.com. It's as simple as that. And if you can, if I may, we have that webinar coming up in July where Brian and I are talking in depth about the 2030s and interest rates, money, inflation, what the world's going to look like, and that sort of stuff. So you can go to our website and see some information.
And we'll put the link in the show notes too, so that way everybody can grab on and make sure that they get and do attendance if they like this kind of stuff. Alan, this has been a blast. I really enjoyed this. Thanks so much for coming on the show.
It was fun. Thank you. Take care.